Hello, Gary Wagner here, just about 1 o'clock in Honolulu, 6 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is December 11th, 2020, and this is the daily report for gold and silver, our weekend review. And after Wednesday's wild downside action in gold, the last 2 days have been relatively quiet. The key right now is that government is still at an absolute stalemate in terms of passing fiscal stimulus, and that will greatly affect the market next week. We'll talk about that when we pull up our technical studies, but first to the price board. Considering the price volatility that we have seen this week in gold futures, specifically on Wednesday when we had that dramatic drop, when we look at our weekly candlestick chart, which is at the lower left-hand side of the screen, you can see that in essence we close fractionally higher, but pretty much unchanged. We would certainly label this in terms of a candlestick type as a doji. A doji is simply a market cycle where the open and close are either identical or a tick or two apart. Gold futures, basis the most active December contract, is currently fixed up $6.10 at $1,843.50. When we look at spot gold, that is at $1,837.50, showing a net decline of $1.50 on the day. And silver had a fractional decline also, only about 2 cents, with March futures currently fixed at 24.07. And that was all in light of some moderate headwinds provided by dollar strength today, up almost 0.2% at 90.97. After Wednesday's sharp sell-off in gold, the last couple of trading days of the week can be characterized by having very tight ranges and an open and close that are very, very close together. That can simply mean consolidation in the market, or it can mean a pivot point or a point to look for a key reversal. However, on a technical basis, we absolutely have to take out this key and critical price point, as I said, at approximately 1,850. From 1,850 all the way up to 1,940, you've got different areas in which we could find resistance, and I've marked those off with these red trend lines. Of course, the first one we just talked about, and that's at 1850. The next one we would have to look at comes in at the 50-day moving average, which is currently fixed at 1878. The 100-day moving average, which is currently fixed at 1915, and between that particular price point, 1915 and 1940, there's virtually no technical resistance, and that is where I'm pegging major resistance at, which is going to be 1940 up into these tops right here that come in just around 55 to 60. Another noteworthy aspect of pricing this week is our current pricing, which is at 1843.50, is roughly the area we entered our last trade in gold. Of course, we raised our stops up just prior to the sell-off in gold and got out at approximately 1850 for a small profit on the trade. Traders taking the call on the open in New York, however, did a little bit better because they got about $20 per ounce or $2,000 per Comex contract. Nonetheless, we are remaining flat going into the weekend with no active trades. And as I said, the most important factor that I'm looking for on a technical basis is a close effectively above 1850. And on a fundamental basis, I believe that we could see higher pricing and a break above this price point if, in fact, the government can come to some agreement on a new round of fiscal stimulus, which is so gravely needed at this point. And of course, another fundamental factor that could have a huge impact on gold pricing next week is the rollout of Pfizer's vaccine, which received a green light from the advisory panel and is expected to be rolled out Saturday or early next week for first responders and those in the medical field. And traders, as I've said throughout the week, now that we see some light at the end of the tunnel, so to speak, in terms of the pandemic and the ability to get that under control and to begin to rebuild our economy here in the United States as well as globally, the economic fallout that will follow, I believe, could last for years. The reason being is we have had a concerted effort by governments across the spectrum throughout the world, allocating tremendous amounts of capital, in essence, as I said, printing money to shore up the economy, to help rebuild the economy, as well as to address the greatly needed aid. Because the trillions of dollars that have already been allocated and the almost certainty that they will pass some sort of fiscal stimulus round two, hopefully before the end of the year, is going to most certainly have a dramatic impact on the dollar. I believe taking it lower, and I believe that is the primary reason that we will see higher gold pricing in 2021, which is why I remain on an interim and long-term basis extremely bullish on gold pricing. And traders, lastly, I do want to take a look at silver. This is the continuous contract representing the March futures contract of silver. We can certainly say that over the last couple of months, we have seen a defined range in silver with the highs up at around $26 per ounce and the lows at around $23 per ounce. We have definitely seen the market basically oscillate between these highs and lows, trading on a number of occasions through this particular channel or range. In terms of resistance, we absolutely have resistance at the 50-day moving average, and that is this green line here. Over the last couple of trading days, it has been the highs that we have seen come in silver, but we have not had an effective close above that. The second thing is that we do have this inversion. We are not in a fully bullish scenario because we have the 100-day moving average trading above the 50-day moving average. I believe that we could see silver remain range-bound throughout the rest of the year. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.